Hello, just making another video of me talking to myself. Hopefully at some point I'll get an audience and start getting some feedback from you guys, but it takes a while to build a YouTube channel. But here I am. I've been trading the options wheel on enterprise products, or EPD, for about 2 months. I just exited the play and have moved into Intel for the time being. In the aggregate, EPD is up a huge 14% over 2 months. However, this includes a huge move up in early January, coupled with an equally big move down in late January. Here are my results trading the option wheel. The orange dots are the strikes of cash secured puts that I sold in January. I sold 7 weekly puts as the stock was rising rapidly, but in late January the stock crashed and my put was assigned. The stock lost 15% in a week. I took a big paper loss on my 100 shares. However, the share price shot back up again in February. I was able to sell 5 weekly covered calls until I was assigned in early March. I actually screwed up this trade in late January. I failed to notice that earnings and ex-dividend date were approaching. I should not have sold a cash secured put in the week leading up to earnings, and nor should you. In the 2 months that I traded EPD, I earned a respectable 3.84% return, or about 23-24% annualized. However, the shares themselves appreciated by 14%, so I left a lot of money on the table. If a stock is going to whipsaw up and down like this, then you need to get paid high options premiums. Speaking of options premiums, here's are the premiums that I collected from selling weekly puts and calls over the life of my position in EPD. You can see that the typical premium is about 1%, which is right at my lower threshold for trading the wheel. So if you have a stock like EPD that has moved up or down 15% several times in this span of 2 months, I would demand a much higher option premium, probably 2 or 3 times what I'm getting with EPD. So here's my covered call screener in Google Sheets. It's automatically updated during the day, and you can download a free copy for yourself if you check the description for a link. Most important thing that I track is cost versus benefit. So for trading the options wheel, cost versus benefit is simply the share price divided by the options premium. If you're trading cash secured puts or covered calls, you have to hold either cash or shares in your account equivalent to 100 times the share price. So that's where I come up with that number. You could trade the poor man's covered call and reduce the cash collateral, but I digress. EPD is pretty low on the cost versus benefit chain, really the lowest of all the stocks that I was trading. So I'm getting 1% in weekly options premium, but I'm subjecting myself to 15% swings up and down. No thanks. The other main thing that I track is relative valuation. I measure what I call the pre-COVID premium. So in other words, this is just today's share price divided by the February 2020 share price. Some of these tech companies are 5 times more expensive than they were in February 2020. Do you think that COVID has really caused their businesses to be 5 times better? I don't think so. And the market is slowly agreeing with me as the tech shares are coming down pretty aggressively as of today, March 8th, 2021. EPD is still trading at 20% discount to its pre-COVID highs, so I'm comfortable that the shares aren't particularly overvalued, but still I've gotten out. I've actually ditched EPD for Intel. Intel has a really nice options premium right now, about 2%. Earnings and dividends don't happen until late April, so we're safe there. And it's still 10% cheaper than it was before COVID. So I highly doubt that it's going to be nearly as volatile as EPD. So I'm very comfortable with this switch. We'll see how it plays out. So in summary, in the 2 months that I traded the wheel on EPD, the shares were up 14%. My trading profits were 4% or 24% annualized, which isn't too bad. That said, I learned a couple important lessons. First of all, never have a short put or call position in the week before earnings or ex-dividend. EPD dropped 15% during that week, and it really ruined my returns on this position. Secondly, you have to decide whether the options premium is sufficient to reward you with the risk of the stock falling rapidly or rising rapidly. When a stock regularly drops or rises 15% in the course of a week or two, then I would demand at least 2% weekly options premiums, probably more. With EPD, you're only getting 1%. So I hope you enjoyed that, and if you got some comments or questions, feel free to leave them in the comments section, and I'll get to them really quickly. Thanks.